Time for Chart Attack. We've got a couple of charts that will make you smarter. Hopefully, it'll shed a little light on exactly what's happening ahead of the Fed meeting. We're going to start with the 10-year, and we've got our closer right here from Cantor Fitzgerald. Peter, talk us through the 10-year, for starters.
Well, to start, we've obviously seen yields rallying, if you will, or the Treasury price falling off or selling off. And that to me, has been in expectation of a taper. And the reason why I think it's the expectation for a taper rather than expectation for inflation is because what we see on the flip side with the U.S. 5-year break-even rate, which has been going the other way, showing deflation.
All right, so I tell you what, Rami, let's bring the camera in here. We got quite a chart. Wait till you look at this one. No, this is not an MRI of my intestine. This is actually the 10-year, and the two lines are the high, the daily high, and the daily low. So you get a sense for the range. You can also see this, this red channel, this upward channel. So yield's going up, Peter.
Yes, and what's also interesting is that range is pretty wide. There's a lot of volatility in the 10-year, and I frankly would not have expected that. But I think when Chairman Bernanke mentioned on his May 22nd meeting that they would look over the next several meetings to start to taper, this is what we get as a result.
Okay, so this is the perception we've been seeing in the trading community. People think there's going to be some sort of taper, therefore the yield has been moving up, even if the taper is not anytime soon. Where it gets interesting is if you go out 5 years. In other words, you look at the inflation rate, the break-even, the difference between the 5-year and the 5-year tips.
Correct.
Okay, so the question then becomes, Peter, and I put this to you, where are we going? They're two very clear, very opposite trend lines. One yield going up, the other yield's going down. Which is it?
Yes. Well, it's interesting. If you also notice some of those support resistance lines that are drawn in there, the Fed has tended to act when the U.S. 5-year break-even rate falls to about 1.5%. We're not there yet, and we're already in the midst of QE. So at best, as you mentioned earlier, perhaps we stay with the status quo. And that's one of the reasons, given where it is, right at that support level, where they start really worrying about deflation, that's why we think they're going to keep the status quo.
Okay, so right now, if we look at those two lines that come together, the yellow and the green, basically they intersect right at about 2%. So that's the market saying that it perceives inflation will be just 2% going out 5 years.
That's correct.
And you think that's a sweet spot, so we stay right there.
Nothing changes.
Understood. Status quo, we're back to what we said in Insight in Action, Trish.